charts show how the contribution from energy prices is falling and turning negative, we think, in the coming months. Now, given Ofgem's price cap on electricity and gas bills and the way it slows down the pass-through of wholesale energy prices to consumer bills, we expect inflation to take a further step down in the July data, which will be published in 2 weeks' time. We think that will come down to around 7% at that point, followed by another larger step down in October's data, which will be published in November, to around about 5% on that basis. Now, this more gradual pass-through also substantially helps to explain the difference between current headline inflation in this country and in the euro area, where wholesale energy prices feed through more directly to consumer prices. Where there is more uncertainty is around the time it will take the other non-energy components of the consumer price inflation to come down as well. Price inflation for food and non-alcoholic beverages has been very high, but it does appear to have peaked, and as you can see in this chart, there are signs in the monthly figures that it has started to ease. And evidence collected by the bank's regional agents suggests that a moderation in food input prices is being passed through the supply chain to consumer prices. So we do expect that food price inflation will come down gradually over the rest of this year. And the contribution from food price inflation falls accordingly in our near-term projection from about 2 percentage points today to about 1.25 percentage points towards the end of the year. Similarly, core goods price inflation continues to be broad-based. It's taking time for the fall in energy prices to work through the supply chain, and the prices of imported goods have continued to rise despite a fall in world export prices. And that's why in our central projection we expect core goods price inflation to come down gradually. But let me be clear, we do expect core goods inflation to ease over the rest of the year, and there are indicators that suggest it could happen faster than in our projection. And as you can see in this chart, output producer price inflation, which measures the change in the price of goods sold by UK manufacturers, has been slowing significantly since its peak in the middle of last year, as indicated by the orange line. Now, that should help to reduce non-energy consumer goods price inflation, which is shown in the blue line, as cost pressures ease in the supply chain. And as the chart shows, that has been the case when producer price inflation has fallen in the past. The final component of inflation is services prices, which is now contributing more to inflation than energy or goods. Now, there has been unwelcome news since May in this area. As you can see in this chart, service price inflation was 7.2% in June, which was higher than we projected in May, and it remains high in our near-term projection for the rest of the year, again as shown in the shaded part. Now, this upside surprise was primarily driven by some of the more volatile subcomponents of services prices, such as airfares and package holidays, and also vehicle excise duty, which is unrelated to the balance of demand and supply in the economy. So we should not read too much into this surprise for this reason. Nevertheless, since other subcomponents of services price inflation are closely linked to underlying cost pressures in the economy, continued strength in services price inflation may suggest that high inflation could persist for longer. Now, that's what I'm going to say on the short term. Let me now turn to the second part of the story, which is the medium-term outlook. Now, of course, over the medium term, monetary policy has to ensure that inflation returns to target in a timely manner. That's why the Monetary Policy Committee is watching services price inflation very carefully, along with other indicators of inflation persistence. Economic activity has shown some unexpected resilience over recent quarters, but the increases in bank rate that we have implemented weigh to an increasing degree on economic activity. There is evidence that monetary policy is restrictive. So as we look into next year, GDP growth is projected to be weaker than expected in the May monetary policy report, and the balance of demand and supply is shifting in our projection. An increasing degree of economic slack is emerging after the middle of next year. This will help to reduce inflationary pressures in the UK economy. As Chart 5 illustrates, In the MPC's projection for consumer price inflation, which is conditioned on the market price for interest rates, inflation is more likely to end the forecast period below the 2% target than above it, albeit slightly. In the modal, or most likely case, inflation is 1.7% in 2 years' time and 1.5% in the third quarter of 2026. However, the committee continues to judge that risks around that central case are skewed towards higher inflation. Adjusting the modal projection for the balance of those risks, the mean or expected path for inflation is close to, albeit just below, the 2% target towards the end of the forecast period. Now, the projection for inflation is broadly similar on the alternative assumption of a constant level of bank rate at 5.25% throughout the forecast period, and that's discussed in the report. And this illustrates that different paths of bank rate can secure a return of inflation to the target. The market curve is higher than the current level of bank rate in the coming quarters, but then falls below it further out, averaging just under 5.5% over the next 3 years. Now, a lot will depend on what happens in the labour market and to pay. There are signs that the labour market is loosening. The unemployment rate rose slightly to 4% in the 3 months to May, and the ratio of vacancies to the number of unemployed job seekers, the so-called VU ratio, an important measure of labour market tightness, has continued to ease, as shown in chart 6. But the labour market remains strong. The VU ratio is still significantly higher than before the pandemic, as you can see in the chart. Annual private sector regular pay growth increased further to 7.7% in the 3 months to May. And this is materially above expectations in the May monetary policy report, and notably stronger than standard models of wage growth based on productivity, short-term inflation expectations, and tightness in the labour market would have predicted. So chart 7 gives you a sort of brief sort of insight and sort of line of sight into sort of more of the entrails of the process, if you like, because what this chart shows is a swathe, which you can see in sort of light grey, illustrating the range of forecasts that we derive from the suite of wage models that our staff maintain. And then you can also see in the line the MPC's projection for private sector regular pay growth, wage growth. That line and that projection is our best collective judgment on the committee, and you can see that wage growth is expected to ease more slowly in that line than the models would predict. So what we have here in a nutshell is that the empirical models illustrate what might happen if wage setting will be based on inflation expectations that take account of the downward path of inflation over the near term. But the best collective view of the committee is that we don't have enough evidence at present to be sure that wages will be set in this way. And in our judgment, upside surprises on wage inflation suggest that it will take longer for second-round effects to go away than it did for them to appear in response to the sharp rise in prices of many imported goods over 2021-2022. And interacting with a tight labour market, that is expected to have resulted in greater persistence in wage inflation, and with it in the cost pressures that determine price setting in the economy. Now, I also show this chart because the difference between empirical model outputs, and I will put models in the plural here, and the committee's best collective judgment, which is obviously clear here, is, I think, one illustration of the importance of reflecting on how our processes should adapt in a world in which we increasingly face significant uncertainty and large shocks. And so with that in mind, I'm delighted, as we announced recently, that Ben Bernanke has agreed to lead a review into the bank's forecasting and related processes. As you know, Ben is a renowned and award-winning economist with a distinguished career, and I think he's an ideal person to lead this review, which is really, what lessons do we derive from this type of situation, and what do we do going forwards? So let me conclude on today's policy decision. The news to wages and its implications for inflation persistence should be seen within the context of the overall data news since June. Now, as we approach the June meeting, data outturns were strong across indicators of inflation persistence. including service price inflation and employment as well as wages. The MPC responded to this evidence of more persistent inflation pressure by increasing bank rate by 0.5 percentage points at the June meeting. Since then, while pay growth has come in stronger than expected, other data news has been more mixed in terms of its implications for the persistence of inflationary pressures, and thus the outlook for inflation over the medium term. And that's why the MPC has voted to increase bank rate by 0.25 percentage points today. Now, given the significant increase in bank rate since the start of the tightening cycle, the stance of monetary policy is restrictive in our view. And the evidence is now clear that it is having an impact. To return inflation to target, policy needs to continue to be restrictive. And today we've taken a decision that's consistent with that, which will help to return inflation to its target. I'm not going to judge what the path of rates will be, not least because, as the report indicates, more than one path may deliver inflation back to target sustainably. We've taken a decision today based on the evidence we have, and we will go on judging what is most appropriate based on the evidence we receive. The MPC will continue to monitor closely indications of persistent inflationary pressures and resilience in the economy as a whole, including the tightness of labour market conditions and the behaviour of wage growth and service price inflation. If there were to be evidence of more persistent pressures, then further tightening of monetary policy would be required. And we will ensure that bank rate is sufficiently restrictive for sufficiently long to return inflation to the 2% target sustainably in the medium term, in line with the remit. So with that, Ben, Dave and I will be happy to take your questions. Thank you.
When you get a hold of the microphone, please let us know what your name is, where you're from, and if we could limit it to one question each so we can get around to everyone, that would be great. We'll start with Ed, and then we'll go to Sue, please.
Thank you, Governor. Actually, so some of your final words there, you were talking about, you were kind of echoing something that was in the minutes about having rates sufficiently high for sufficiently long to bring inflation back to target. I just wonder, can you expand on that a little bit? Because there are many households out there, they're looking at interest rates, they're hoping that after they were high for a while that they would start to come down. Are you saying that actually we need to be prepared for interest rates to be high for longer than a lot of people might be expecting right now?
Well, let me start. I'm sure Ben will want to come in. It's worth starting, I think, with the market curve, because, of course, the market curve does have a fall in interest rates, but it goes higher before that happens. And I made the point in the opening remarks about what that delivers as an average rate over time. Now, there are many potential paths, but we have also shown, as we always do, but I would draw attention to it, what happens if you do the constant rate. So you assume it's constant at today's rate, which is another potential path. And that delivers, again, a return to target. So the point I would make is that we have to balance the risks here. We've got risks both ways, I think. There are inflation risks, certainly on the upside, which we've reflected in the mean projection. I would highlight, and Ben may want to come on to this point, that relative to May, more of the risk that we saw in May we think has crystallised and is in the modal projection, but we still have a mean projection. It's just a smaller mean projection than we had in May. But we're also, of course, conscious that the projection for activity has weakened because the curve is higher than it was in May, and we will have to bear those, that path and that risk in mind as well. Ben, do you want to?
No, I think that's very well said. As Andrew says, there may be different paths that achieve the same end. Just one particular point, there was a lot of focus in May on mortgage costs. Those mortgage costs respond much more these days, given the shift in maturities to 2 or 3 year interest rates, than they do to the overnight rate and to bank rate. And that's one illustration of how there might be lots of paths that keep that 2 year rate roughly stable. And you talked about what people expect. At least 10 seconds before we came up here, we had a look at the reaction of the market curve and specifically of 2 year interest rates to today's decision. And they moved very, very little. Immediately before and after the decision, I think they were down 3 basis points. So I don't think that this has had a tremendous effect, either what we've done or that point, which I think was well worth making. has had a tremendous decision on that 2-year interest rate, or therefore the equivalent, say, quoted mortgage rates, or indeed 2 or 3-year interest rates facing businesses, which also matter.
And if I could just add one final point, where we go, which path we end up being on, as Andrew stressed at the end of his remarks, will depend on the evidence and on the evidence of persistence. That's what's driving the decisions.